Hey everybody, today is Friday the 9th of August 2013. This is Brian Shannon speaking from alphatrends.net. Let's take a look at this market. We did see a little bit of weakness here. S&P down about 1%. You can see Nasdaq down about 2/3 of a percentage. And some of the markets that got hit harder were the semiconductors and the financials, which are now down not year to date, of course. They still have hefty gains there, but month to date, we do have a number of these markets in the loss column. So we're still in an uptrend, though. Every time we have a little bit of a pullback, everyone wants to call a top, and we don't have any evidence of a top. We still have a rising 50-day moving average. We still have a rising 100, 150, and 200-day moving average. We're still in a primary uptrend, and it's going to take distribution to get this thing lower, and it's going to take time. But as we've done all year, what we want to do is when the market starts to pull back a little bit, we want to look at it and say, okay, now's the time to get a little bit more cautious perhaps. We've got an important level below us at about this 167 and a half-ish area, really 167 and a half up to 168. This week, basically our low is about 168 and a half, and a little further pullback I was calling for last week. I believe that I'd like to see some further pullback in this market. We've had a great rally, and it makes it healthier to actually pull back and give these stocks a chance to set up again, and the markets to set up again for low risk, higher probability trades than what we have right now. So for this week, let's take a look at the 5-day chart here. This is this week, and what we have on here, that gold moving average, is the volume weighted average price. The average price the S&P traded at this week was but it was 169.63. So that was the VWAP for the week, and you can see we found a little bit of resistance there today. That wasn't something we would have wanted to see, actually, and you can see that this has been kind of a little bit of a pivotal level this week at about 169.70ish. So we're going to go into next week with a little bit of caution at first. We do have here on the 10-minute time frame the declining 5-day moving average. That's this orange line, and we have now for this market to get back into upside gear, we're going to need to see it really get above and hold above this basically 170.15 level for at least a half hour or so, and then we can kind of feel that maybe this little near-term corrective mode may be over. Or if we break down below that 167.70, then we've got a possibility, I think, that a pretty good possibility, that is, of heading down towards the 50-day moving average. The 50-day moving average, you can see in the bottom left corner, that green number is 165.31, and I don't think it would cave into that level, but it's certainly a possibility. It's also, if we take a look at this 65-minute chart and we take a simple Fibonacci and measure off the lows of June up to this recent high, that would get us, 165.15 would be where we see a 38.2% retracement of this move, and again, the 50-day moving average is down at 165.31. So that's another reason to think that that area might offer some support. And we also have this prior resistance area, and of course it would close this gap as well. A lot of people look for that gap to get filled. It hasn't done it, and eventually it will. Perhaps next week, we'll see, but we want to go into next week defensive and near term, I'd say guilty till proven innocent. That is over the intermediate term, and as long as we remain below about 170 and a quarter. Longer term, we're innocent till proven guilty. We're in a rising market, but we're experiencing maybe a little bit of corrective mode here. The Nasdaq, also is maybe due for a little correction here. You can say it's maybe making this even a little bullish pennant, but the fact is, we have a long-term bull market. We have for several years. No one has picked the top in here correctly yet, and we've seen countless calls for the market to continue lower. Last time, or to reverse and go lower, because it doesn't make sense. It's only because of the Fed, because of Korea, because of Greece because of the fiscal cliff and all kinds of headlines. Last time we got defensive was over here when we were below that declining 5-day moving average, and then we turned more bullish as it got back above. Now we're seeing here, similar to the S&P 500, where I'm not sure I pointed it out, but we do have a lower low for now, and that's what makes that level important. We do have a slightly lower low at 77-ish, but we're in a primary uptrend. This is looking like perhaps corrective mode. If we break down below this 76 and a quarter level, then what we would be looking for on this 30-minute time frame is probably a move down towards $75.75. If we take a look at some Fibonacci off of here, and I don't like to use a lot of complicated technical tools, price, volume, moving averages, and you'll see that in the markets I don't really reference volume a lot, that is on these ETFs, because the market's been advancing on declining volume for years. But this 38.2% retracement is where we got down to this week. That is, and I didn't want to draw that line there, we've retraced since the most recent important low in the Nasdaq, 38.2%. So pull back into that area would not be a bad thing. Russell 2000 lost a little bit of ground in here. It's got that lower high, and really for the buyers to regain the control in here, what we'd be looking for is for this market to at least get back above and hold above. I'm not good at drawing a straight line here apparently, about 104.60. Getting back above and holding above that level would then help us become a little bit more bullish. We do have, and we've kept our eye on this 102.75 to 102.90 really to 103 as an important level of support recently. So we've got that as our potential support if we continue to pull back a little bit. And if that breaks, well, then we start to look at Fibonacci in here as well, off that most recent important low from where this rally came. We also would see this market get a 38.2% retracement down at this 101.20 level. So we're near term guilty till proven innocent below that declining 5-day moving average, but it doesn't mean go out and get aggressively short because the primary trend is still higher. If you're going to sell short, I still believe that short sales should be meant for day trades. Maybe that changes and we could get a little bit deeper pullback if we break below and hold below 103. And the way to do that is let's say this is where the market is right now, and we don't see everything to the right of this chart. What I'd like to see happen would be maybe a quick move down below, make a lower high where that support acts as a resistance, and then to be shorting any after these little rallies in here for a move perhaps again down towards even the 50-day moving average in there. So some key levels in there. Semiconductors, really, we've been talking about them as being more neutral, and this 38 level continues to be important. We do have a lower high coming in to next week. So back below, I'd say 37.90, it would be reason to be a little bit more cautious in here. The financials were, lost a little bit of ground as well. Well, what was it, 1.8%, and the semiconductors were also down 1.8%. But we saw this market, the financials down 1.8%. They've had a phenomenal year. They've had this massive uptrend the last couple of years, and still in a primary uptrend. But a pullback down towards that 50-day moving average near the 20 level would certainly seem reasonable to me. And this market really is, I think, a little bit weaker on a relative strength basis because we have now a second lower high, and we're going to need to see $20.60 taken out in the market hold above that before we really can get more bullish once again. Breaking below 20.35, I think that's pretty much an easy move down towards that 50-day moving average. And sorry for jumping around on the time frames. Here we're looking at a 65-minute time frame, and we can kind of see these levels a little bit more clearly. I do have a 5, 10, and 20-day moving average on there as well. Not 5, 10, and 20 period, but 5, 10, and 20 day. Under popular posts, there is a article about doing the math for that for those time frames. I won't go through it again here right now, But let's take a look also at Apple. Apple, began to pull back in an area where it made sense to pull back. That is, it briefly got above the highs that we had seen back in March. We've experienced a real strong rally, and we started getting very cautious on it as it made those lower highs and as it broke down below yesterday that 5-day moving average and held this prior support as resistance. So a couple interesting areas to note in here are one, we could take a look at the volume weighted average price since the event, that is since the earnings, the volume weighted average price. We basically came right down to that level today. So that's interesting to note. We also have, if we take a look at that 65-minute time frame, that is each candle represents 65 minutes, the volume weighted average price since that low, that is the the low that we saw in June, is about $435 a share, and we have a trend line here as well that comes in at about 442, and then so this is where we have the potential to pull that back down to. I also think it's interesting that we could see $437, as you can see in the bottom left corner, is the year-to-date volume weighted average price. So perhaps we pull down to that 447 level, and that kind of puts us on this trend line that we see on the 65-minute time frame. So I think 445-ish really kind of makes sense. If we did a Fibonacci off of, we could do it two ways. We could do one off of the lower low, and that would get a 38.2%, would be about 440. Or since the earnings, I think this is probably more relevant to today's psychology, gets us down to about 451 for a 38%, and 445, and also that 20-day moving average down here. So I think 445, 447 is where it looks like Apple should be headed. It doesn't mean that you should purchase there. It means that that's where I think it makes sense to start looking for opportunity on the shorter term time frame, that maybe we're back above a rising 5-day moving average. The 5-day moving average begins to flatten out and that sort of thing. I had mentioned on Thursday rather, I'd posted some stocks to Alpha Trends, and I wanted to follow up on those. Now, this is one that Alpha Trends gold and silver subscribers got involved in on Thursday as it broke above $16.60. I'd suggested raising the stop, and then today it did continue higher. But you can see here that this was the proper place, in my opinion, to get out of the stock at about $18.25. So a nice winner there. Under Armour, we had gotten involved on Thursday as well. I had suggested raising the stop, I think a little bit too tight, so officially you would have gotten out of it here this morning. But if you look at the way it gapped down right to the 2-day volume weighted average price, so since that move began, and then held above the VWAP the entire session, if you didn't kind of get panicky on the open, that this would still be okay to hold. And now if you personally are still in it, officially we're stopped out, a stop of $72.30 is what would make sense to me right now. Shares of DEC did not trigger. We were looking to buy them on strength above $58.76. I still think this is a good one to watch for next week. If it can clear that level, I think we're going to see this stock break out here, and then on the weekly time frame, it's definitely got some room to run. If you look at the monthly chart, it's no stranger to these giant pullbacks, and then some really great rallies have developed from there, and I don't think it's going to develop that big, but it certainly is worth noting that we could get some near-term momentum if it got above 58.76. ELLI we had been looking at and got involved in Thursday in Alpha Trends just as it started spiking in here, and I had suggested raising your stop, so that one should be stopped out. And as I had mentioned in chat on Thursday, that you always want to sell at least half of it into strength like this, where it just kind of gets that huge strength that you didn't see coming. Shares of INCY did trigger here a buy today, so that one, I think that now the stop ought to be raised up to about $26.45, in shares of Insight. And again, it's a biotech. Be aware of that. But it has a great looking chart and has room to run. WFT was stopped out at 1440. And the thing is here, you've got to have discipline. So it was a small loss in there. Now on the daily time frame, it still looks like it has room to run, as does the weekly. But your discipline has to be there. You have to have a method to the madness. And if you're involved in this stock and you're still holding, then I would say, your worst case stop would go below the low of not Friday, but of last week, down here at about 14 and a quarter. But we're stopped out. I'm going to say that we want to continue to keep an eye on it. However, AIG, we were looking for it to pull back and then show some strength. It didn't. It just pulled back. It never showed the strength, so there's no reason to get involved. It didn't take out yesterday's high. It still looks like something that's worth keeping an eye on. I'd say you'd probably want to set an alert at about $48.70 in AIG, and then determine whether it's something that makes sense to take the trade. The CHK did trigger by trading a penny above Thursday's high, so that was purchased at $25.20. And I think that now your stop probably ought to go below the low of today. So at about $24.80 would be a stop in CHK. Good looking daily chart there. Halliburton did not trigger. It got up again, $46.49. So it's hit $46.49 3 or 4 times, $46.49 and $46.50 3 or 4 times here in the last week. It's still got these higher lows, and I think that getting back above 46.50, that's the key that's going to lead to some momentum. Right now, I would say that your stop would have to go probably down at about 40, maybe $1 away or so, but it definitely is worth keeping an eye on for next week. This MLNX that we were talked about as a short sale candidate because it's in a downtrend did fall apart nicely here. If you got involved early in the stock today, then you had a good profit. I always suggest taking partial off at daily S2 when you get a quick move, and then now your stop, I think, on the balance, if you hold some, is at $43 and $43.50 would be a place to put a stop there. Shares of Ren. Now this one again, it's a crazy little Chinese stock, and I had mentioned that it looked like it was holding up and getting above this 398 could get it going. It looked like it wanted to go. It got tripped up here. I wasn't able to make a higher high for the week, and I said to risk a dime in it, so it came back down and disappointed myself and other people and got stopped out there for a loss of about a dime. Next week, perhaps it gets going again. I think about 410 is the important level to watch there. Finally, we had also mentioned Yoku as something that had the potential to get going. We wanted to see this stock purchase it on strength above Thursday's high. Of course, that never happened. The gap lower nullified the trade right on the open. There's no reason to buy the stock now. You got to let it reset up. You can't use that as your trigger anymore, so just take that one off the list. I hope everybody had a good week and enjoyed the stock ideas. Anyways, if you did, this is something I do every single day for subscribers at Alpha Trends. Give it a 7-day trial if you like, and hope you have a good weekend. Thank you.